Donald Trump says he will announce his pick for the next chair of the Federal Reserve as early as next week, signaling a potential shakeup at the top of the U.S. central bank. Speaking during a cabinet meeting, the U.S. president said he plans to name his choice to replace current Federal Reserve Chair Jerome Powell, whose term as chair is set to expire in May.
We're going to be announcing next week, I think sometime, Scott and Howard and everybody, we're going to be announcing the head of the Fed, who that will be. And it'll be a person that will, I think, do a good job. We're paying far too much interest in the Fed. The Fed rate's too high, unacceptably high. We should have the lowest, and I think you read my statement today. I put out a statement before the meeting, but we should have the lowest interest rate anywhere in the world, because a lot of these countries are successful only because of us, because we allow them to have surpluses. And without surpluses, some of the countries that you most respect financially, that you say, oh, this one, that one, this one, that one, they're successful because we allow them to have surpluses. And we could easily stop that with the powers that we have, but we don't. We took some of it, but we took really just a small portion of it compared to what we could take if we wanted to. We should have the lowest interest rate anywhere in the world. They should be 2 points and even 3 points lower. And if it was, each point is the equivalent of, I would say, $500 billion. So if you got 2 points low, you have $1 trillion in saving, and it's almost, if you call it just a paper expense. You can do it with a pencil. It's not cutting. It's not saying we have to get rid of jobs, or it's just like literally so easy to do. But we have a guy that doesn't want to do it because he's, I think he's politically biased. I really do. I believe he's politically biased because most smart people say it's not even a question.
Trump has repeatedly criticized Powell for refusing to slash benchmark interest rates to levels Trump believes would boost economic expansion. Powell, however, has consistently defended the Fed's independence, arguing that monetary policy decisions must be based on inflation trends and labor market data, not political pressure.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned, in part, a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
Even after Powell's term as chair ends, he could remain on the Federal Reserve's Board of Governors until 2028, a move that could complicate Trump's ability to install a new chair from outside the board. The president renewed his attacks following the Fed's latest decision to keep interest rates unchanged. Powell said the central bank would continue to hold rates steady, signaling no urgency to lower borrowing costs despite mounting political pressure. While acknowledging that inflation has eased from its peak, Powell emphasized it has not yet been fully defeated.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 percentage point, bringing it within a range of plausible estimates of neutral.